Hey, what's up, my friend? So, in today's episode, we have Aksel Kibar. He's an ex fund manager and a classical chart pattern trader. So, one thing that's interesting about Aksel is that if you follow him on Twitter, or not nowadays they call it X, right, you realize that his charts, right, honestly speaking, is one of the cleanest that I've come across, right, on the platform. Okay, he doesn't have those messy indicators, squiggly lines covering all over the charts. No, his charts is very clean, and one look at his charts, right, you would kind of like sense right what the market is trying to tell you. So Aksel really has one of the best charts that I've seen on the Twitter platform, or should I say X platform. Anyway, if you want to connect with Aksel, right, I'll put his social media profile in the description below. Now, during my conversation with Aksel, we covered a few things. First, we talk about his life in the army, what are the things he did and the lessons he learned back then. Then we spoke about how he landed a job as a fund manager, right? Let's be honest, this is a job that I think most of us want to get, but we just somehow, right, do not know how to go about doing it. So he shared the process that he did, right, to land a job as a fund manager. Then moving on, he talks about classical chart patterns, right? Because this is the way he trades the markets. He shared with us, what he looks for in the charts, his entry, stop loss, and targets. And then he also shared, right, the 4 types of breakouts that I personally feel that every trader should know, because not all breakouts are equal. So he shares, right, these 4 different types of breakouts, how you should go about, identifying them, how to trade them, and how to manage the breakout trades, right, depending on the type of breakouts that you are encountering. And then finally, towards the end, he shares about how he goes about scanning the markets for trading opportunities, his daily routine and weekly routine. So we are going to cover all this in today's session. Go listen to it right now. Okay, welcome Aksel to the show. I'm so happy to have you today.
Hi, Rayner. It's a pleasure to be part of your show as well.
So to kick things off, right, I once heard, right, that I think on another trading podcast that you were in the army. So maybe, to kick things off, so what were you doing in the army previously?
Well, the army is in Turkey. It's a mandatory service, so we cannot exactly say that it's a hardcore military service, but everybody has to do it, and I was one of them as well. So basically, this is how it works. Over the years, they shortened the period of the military service in Turkey. My parents used to do it uh, 18 months and maybe even more. Some have done 2 years service. So in my case, what happened is that if you're a university graduate, you are only doing it for 6 months. So the time shortened and shortened, and now I think it is paid service. So if you, it's like basically they hire military personnel. So now what I have done is a 6 month period. I had the option to do it 12 months with a higher rank, but I decided to go for 6 months as a soldier. And I was a marine soldier in the west coast of Turkey. It was, I would say, everybody in the beginning is scared of the military service and they feel like it's a waste of time and it takes away from their life, etc. And then when you talk to people who have done it, uh, they have always have good memories. And I never thought that I would have good memories after it, but it's true because you get to meet a lot of interesting people there from different parts of the country, different levels of education. Uh, it's funny, it's stressful, um, and I mean, there is obviously always a risk of war, but it's more of a defense part of things that keeps you always uh, alert. Not that you're going to go to a war, but at the base, basically, there was always stress. That stress keeps you alert, And in the beginning few months, because of that stress, you really forget what you were doing in real life. And the first month is usually the basic training, disciplinary training, the orders, and so on. And after the first month, there's the ceremony, and then you move to the next stage, which you spend 5 months and a little bit more expert status. In my case, almost in everybody's case, they try to look for your educational background and try to utilize that. So if you're an engineer, you might be taking part in the car workshop. If I was an economist, so the best suitable section for me was the accounting department of the cafeteria. So I was responsible from 6 different stores. And basically, this came after my 4 years of economics study. And I would say that I learned the most in that military service accounting department or the supermarket section than 4 years of economics study. So it was such an interesting experience that you get to learn, because we had a base of 1,000 people, and 1,000 people fills up the base, and then they get their training. After 2-3 months, they are moved to their original military bases. So we were basically a training camp sort of a place. And so you max to 1,000 and then you drop to 100. And I've seen this cycle twice during my 6-month stay. And when it reaches to 1,000 people, you're talking about a huge economy there. Okay. So let's say the restaurant doesn't have good food. Everybody piles up to have a toast, to have some kind of snacks from the cafeteria, and the sales go up like crazy. So military is not supposed to profit from sales. So we buy things with boxes. And when you divide the items into 25 units or 30 units, you get a price tag of the cost is 22 fills. So you cannot round it to 20 fills. You have to round it to 25 fills. So when you round it to 25 fills, you get 10 to 15% profit. And over 1,000 units to 2,000 units of sales, you get to see a massive profit building up in the cash registers. So basically, I've seen what the population has an impact on the economic success of small stores. So the masses going wild on water in the middle of the summer, and all these small profits piling up is giving you some kind of crazy profit at the end of the month. And obviously that profit was being distributed to soldiers in need who don't have the financial support from their families. So like some kind of a salary being given to people in need. So that was the economic background of what I have been doing. I was responsible from 6 different stores. At the end of each month, we used to basically try to match the cash register and the items that are being sold, etc. Ordering of utilities, be it toilet paper, T-shirts, tea, you name it, everything that was available. So buying the newspapers, making sure that the stocks are available were all my responsibility. And I was managing 6 different stores, out of which 3 of them were kids that have had the university background. Three of them were primary school graduates. So as you can see, different educational levels from different parts of the country, and the university grads were able to match their cash pile because you give change. You take, let's say, 1,000 Turkish lira, and you give change. Sometimes the other kids were making mistakes, so there were shortfall in the cash. So they had to basically put it from their pocket from those mistakes. Yeah,
Ouch.
yeah. So that's life. So you get to see different parts of the country, different educational levels, and these all were good memories because it all taught me um, what life is about. Because you don't get to see when you're working as an economist or an analyst in a bank, you don't get to see everybody, all kinds of profiles. But in the military service, you get to share the room with them, and with different people, different educational levels, different status. Uh, so it was a different experience. I enjoyed it, and like people who have commented on it after completing their military service, I also share the same views. Now, they always say that even if you want, you cannot go back. And that's true. Like, and I'm always telling my friends and my family, I wouldn't mind to go and spend 2 months now with the same crowd and doing the same things. So it was that part. It had to be done, but I'm glad I was given the chance to do it for a longer period.
I can relate to it as well because in Singapore, right, all the male, we have to serve a compulsory 2 years national service. I mean, it used to be 2.5, now it's about 2 years. Then they slowly cut it down, just like, what you said for your country. So yeah, many lessons learned. And I think for most of us who completed our time in the army after the 2 years, we all kind of like nod our head, yes, that was a good experience. We initially, when we thought going in, it's a waste of time, I'm holding back my career. But when you look back, yeah, the lessons learned are stuff that you won't learn elsewhere. You learn about how people really behave, right? Their true colors, your EQ, how do you interact with others of different status, others of different personality and background. So it was very enlightening for me as well. So same sentiments, right, as what you've shared after going through the army. So my next question to you is that, regarding the army, so what is maybe some of the lessons that you learn, right, while going through that 6 months journey in the army?
The lessons, I mean, relationships matter. This is something that I've learned from it's a replica of corporate life as well. The pecking order, um, ranks, um, what you should be doing and what you shouldn't be doing, basically. Rules based, strictness, the discipline. All those were very, very much helpful later in life, that you get to see those, and then you move to a corporate life, or even in life, you get to see that, okay, this is the pecking order. We have to respect that. We cannot step ahead and step over the hierarchy. There is that hierarchy. It has to be there. We have to follow certain orders. And in general, I have always been a disciplined person, be it with following up things and waking up time, etc. So those qualities helped during my military service. So many funny moments related to that.
Maybe could you share like any funny moments that come to mind?
Uh, I mean, when you're serving, one of the most important thing is we get because we used to drop to 100 people in the base from 1,000, and when it is 100, you get to do all the chores yourself, 100 people. So you cannot basically give it to the newcomers. So you have to handle it yourself. And serving was one of them, with basically serving at different parts of the base. And at 12 o'clock, at 10 o'clock, we used to start, 10 to 12, 12 to 12 to 2, 2 to 4, and then 4 to 7. So, and because we were short in numbers, every day they used to write a location to be served. So basically, you go and get your gun and go to the serving point. And the place that I was basically guarding was the ammunition depot, which was right across the cafeteria, supermarkets, warehouse. And so my friends used to pass by in the middle of the night when I was serving. They are also serving. They were duo, and I was alone on one side. And they used to ask me, "Come on, can you get us some tea from inside?" And I used to say, "No way! Like I cannot move from my place because if the commander and if the commander comes, you cannot do that." So they used to change with me a place. One of the guy used to stay in my place. I used to walk with the other guys and open the store and get them in the middle of the freezing winter some tea as they were serving. So I mean, these are friendships. You cannot break that because you live with them. You're sharing the space. You know, those are the small things that you have to basically violate. But yeah, good days.
When you mentioned serving, do you mean like staying on duty, remaining at your spot to make sure no one
Yes.
comes as serving?
Yeah.
Okay, okay.
Yeah.
Maybe just one last question before we move on. Right? So, as you were, in charge of the store, selling items. So, what are some of the more popular items that people in the army love to buy?
It was more food items because whenever there's the food in the restaurant is not that good, they used to pile up for toast and tea in the winter. So tea was 1 Turkish lira at the time, before all this inflation and so on. So the guy that was managing the tea store, um, 1 month, he had a big shortfall, large amount of shortfall. And when we asked, we realized that his friends are coming and saying, "Can I get one tea?" And he gives the tea, and I will pay it later. So that 1 Turkish lira is not possible to collect from here and there. So it piles up. 100 kids, it's 100 Turkish lira shortfall. So that's like 10% of the population of the base in one day. So if you repeat this 5 times a month, you have a shortfall of 500 Turkish lira, and that's a sizable amount. Where the salary that the military service was giving to the soldiers at the time was 35 to 40 Turkish lira. So that 10 times that's 10 times the money that they were paying for the month. Yeah.
Okay, so let's maybe now move on, right, and talk about the fund management world, right? Because from what I've gathered, you were a fund manager back in the UAE, right? So curious to hear what's the process like of getting such a job back then.
So here's how it started. It's an interesting story as well. After the military service, this military service comes after my master's degree in Canada. So I was one of the first in the family that traveled abroad and studied, and then came back, finished the military service, and after the military service, I started looking for jobs. And I found a couple of jobs in Turkey. In one of them was I started in Garanti Bank, one of the biggest banks in Turkey. Their asset management department. I started working, but it was a 2 weeks journey, because meanwhile I was receiving emails from a couple of friends that they're looking for a CMT charter holder in Abu Dhabi. The National Bank of Abu Dhabi was looking for a CMT charter. And at the time, I started working in Garanti Bank as an investment analyst. So that had a lot to do with the fundamental research. And I enjoyed charts and I enjoyed the technical side. But as a start, I was okay to take the investment analyst job. But meanwhile, because I received this email from another friend for the third time, I said there is something about this, so I should consider it. And I didn't know where Abu Dhabi was at the time, because the advertisement was 45 minutes to Dubai. So when I talked to friends, they said Dubai is the New York of Middle East. So I started searching the bank, National Bank of Abu Dhabi, semi-government owned bank. So when I started searching, I said, this is a good opportunity. Maybe I should apply for it. And I applied for it. And the answer came as, we need a little bit more experience in the field. And this was 2007. And at 2007, I graduated from economics in Turkey 2004, got my charter, and then after that, master's. And when I was studying economics, I also did an internship in Yapı Kredi Bank, which was also a big, one of the biggest banks in Turkey. So while doing all those, experience was not possible to fit somewhere. So you cannot get the working experience. I had an internship experience, which was almost like working, because I did half day school, half day bank for 3 years. So they asked me, they told me that we're looking for more experience. So I didn't take no as an answer. So I wrote back, because I was very comfortable with my knowledge in charting and technical analysis, and I knew that I was good at it. So when I wrote back, my ex-CEO liked the reply, and he liked that I challenged it, and he got back to me, and they basically set up an interview call. And after that call, they were convinced that I had the knowledge, which probably compensated for the experience side. And then I got a job offer from there, and I had to excuse myself from Guarantee Bank, which they were not very happy with. But they hired the management the more understanding they were. So the CEO was more understanding, and he said that we understand it's a much better offer, and your place is available if things don't go well. So I took the offer, and I flew to Abu Dhabi. And I started as a technical analyst at the National Bank of Abu Dhabi. It was 2007, and we were gonna get hit by the subprime mortgage in few months, basically. So going to a land which was the most affected by subprime mortgage and the real estate crash was a really interesting experience, because when I went there, the markets were already falling down from 2005 till 2007. They were already in a downtrend, and people didn't want to even talk about stock market. And I saw the opportunity that the market is bottoming, at least for a short relief rebound. So at that point, I joined the department, asset management department, as a technical analyst. And I had a couple of good calls because the market was rebounding and there were nice classical chart patterns appearing. So it was an opportunity for me to show my skills, which later on gave me the opportunity to manage funds, because I had some good calls and caught some nice ideas. So that basically helped me to get the fund management, get to the fund management side, which I was given in 2008. The UAE National Bank of Abu Dhabi's UAE Trading Fund, which was the largest fund in the UAE at the time. I think somewhere around $500 million. So I started managing that during the subprime crash. And UAE is it was not a diversified economy at the time. Now there's more IPOs, malls, etc. Entertainment side is being IPO'd. There was not even the airline that was IPO'd at the time. So it was more like banks or real estate, and both are getting hit because of the real estate collapse. But banks held much better. Real estate side of things fell apart. So it was a difficult period to manage that in a illiquid market at the time of the crash. So that's my how I started, basically. First as an analyst, and then as a fund manager.
So as a fund manager, how do you then manage the money? Do they like, hey Axel, here's $10 million, grow it to 20 million, or do your best or whatsoever? How's like the process of managing that money?
So we had our funds were benchmarked against the MSCI UAE index. And there was this MSCI UAE domestic, MSCI UAE international index. There were two types of indices. The domestic was internationals were not allowed at the time to invest in certain stocks. Strategic telecom company, for example, was not available for investment. But local funds were able to invest in those. So, for example, we used to look at MSCI UAE International Index and MSCI UAE Domestic Index, and we used to run the funds against this benchmark. And we had 25 to 30 names in it, approximately, maybe less even. So you didn't have a wide universe, okay? And real estate, for example, MR properties was close to 25 to 30% of the fund. So it's mostly taking a bet on big names, like by just underweighting the real estate sector from 35 to 40% to 20% was giving you the opportunity to generate alpha. So it was a bet on you're into banking sector or you're into real estate sector. So by making that call at the time of the subprime crash, which started hitting the UAE market a little bit later than the US market, the crash started a little bit later, and I was able to liquidate large amount of real estate. And at the time, the Dubai real estate got hit more than the Abu Dhabi real estate because Abu Dhabi was one step behind in terms of development. So they were not caught in the middle of development stage. So they were still initiating projects and trying to catch up with Dubai. But Dubai already built their man-made islands, the villas, the high-rises, marinas. So that market got hit first. So the stocks that were listed on that exchange were more liquid as well. So it allowed me to basically reduce the exposure on those. The basic idea was when you are managing it against the benchmark, you have somewhere to hold on to. It's easier than a complete blank sheet because you just need to look at the relative performances against the index and see the stocks that are underperforming. Start with that. Stocks that are below their long-term averages, start with that. You don't want to be neutral even in those names. So any cash that you can raise, I was basically allowed to go into MENA equities outside of UAE. So we had the allowance of a 30% off index exposure, which was giving me, at the time, my CIO told me that this is more like a satellite approach you're applying here. So the underweight positions, the cash that you get from those, I was applying into MENA equities, Saudi Arabia, Qatar, Oman. So I created this wide opportunity set for myself and started exploring breakout ideas. So that's my basically starting point with the breakout strategies, because I was trying to capture a couple of weeks of strong directional movement with this cash that I have taken out from underperforming names and trying to generate more alpha on the directional moves that I was able to capture in off-index names. So when you go into off-index, you have slight risk because you're moving away from the benchmark, but that's the only way to outperform an index. You cannot hug the index. You have to move away a little bit. And I used to take, for example, 4 to 5 different positions outside of the index and try to capture those directional moves, which brought me to my current strategy today, that you start with a blank sheet and you look at a wide universe of breakout ideas.
This brings me to my next question, which is, why breakouts? Because I think from what I've gathered, you've tried many types of trading approach, right? Indicators, patterns and stuff like that. And now I think you mentioned, you went with the breakout. So why breakout?
Why breakouts? It's a good question. When I joined the National Bank of Abu Dhabi, my CIO was obviously advanced in charting and technical analysis. He had this knowledge. He sat with me and he said, Axel, in these markets are momentum driven. So there is less market makers in these markets, and it's more emotional and psychology driven moves. So with that mindset, I went through the whole universe in the region and started looking for those type of tight consolidations and how stocks are behaving and so on. And I came to realize that yes, you have more and more stocks breaking out of a consolidation and they are rallying. Trends are more persistent. It is not there. People are not fading off those trends; they are piling up into those moves, and that's how basically I started applying flat range breakouts in stocks. It was more of a kind of a direction that I was pushed towards to explore these side of things. And then as I looked more and more into breakouts, I came to realize that by just adjusting the time frame, you still have the chance, even in international stocks, these type of consolidations that you can play as a breakout strategy.
So would you say that, earlier you mentioned your CIO said that in these markets, I think he's referring to markets which are less watched, or maybe markets which are not as popular, like maybe stocks like Tesla, Apple, etc. This type of stocks, their breakouts tend to be more real compared to the more popular stocks like Tesla, Apple, Amazon. Those type of breakouts, they tend to not work as well. Did I get that right?
Yeah, I can say that the most popular names are more crowded, obviously, but that doesn't mean that you cannot find breakouts in those names. It's just they probably form less frequent. And for example, on Tesla, you might find a 5-year-long consolidation breaking out, but that's a 5-year-long wait. If you go and try to find 2-3 month long consolidations, textbook tight consolidations, it might not happen on Tesla. Less popular names might have those opportunities more frequently, but very liquid and crowded stocks will give you less frequent opportunities like that. For that reason, I made sure that I look at a wide universe. I spent a lot of time going through charts, and for me, ticker doesn't matter. So I don't even look at the ticker. I just look at the chart itself, the right side of the chart, and try to see the consolidation that I'm looking for. So many people are trying to focus on too many patterns at the same time while looking at a single name, which is forcing them to find something on the chart which doesn't exist. So what I'm doing is that I have a wider universe and few select patterns that I'm trying to look at. So I'm not limited to a crowded trade. I can look at less popular names and try to capture that directional movement as well.
Okay, so could you then share, what are the things that you look for, right, in a chart? From what I've gathered, things like rectangle is one of your favorite patterns, so maybe you can go into some details and share about what you look for.
Yeah. So let's say, first of all, my main motivation is to look for patterns that are horizontal. Horizontal patterns have the advantage of being able to manage the trade with a predefined stop loss. So, for example, a symmetrical triangle have an downward sloping upper boundary, and at the time of the breakout, you act when the stock is breaching the upper boundary, and you place a stop loss below the pattern boundary. That's the logical place to put a stop loss, protective stop loss. So right after that, if the stock starts pulling back sharply, it goes back to the boundary. It is below your stop loss, but the pattern is not violated. So that's a challenge with the diagonal boundaries, trading the diagonal boundaries. New traders, new analysts always have this tendency in the beginning to draw trend lines and diagonal boundaries for some reason, which how can I say, takes away from their couple of years of practice to focus on horizontals until you realize that the meat is actually in the horizontal setups. I lost as well easily 1 to 2 years of my time looking at these trend line breakouts and so on. So what I have focused is the horizontal setups. So out of 8 classical chart patterns I have defined, 7 of them are horizontal setups. So for example, ascending triangle, descending triangle, head and shoulder continuation, head and shoulder bottom, head and shoulder top. Rectangle is another one. Cup with handle is another one. And the 8th one is symmetrical triangle. This is one of the most popular. So I only look at symmetrical triangle as a chart pattern with a diagonal boundary. But out of all those, my favorite is rectangle because of its frequency. So frequency is important. You don't want to end up with 50 ideas for the whole year. You want to have 100 ideas, 200 ideas to pick and choose from, because once you find the idea, it doesn't mean that it's a good trade. You have to go back and check slightly its fundamentals, the volume pattern, etc. If there is a news pending right before a financial announcement, you don't want to trade that pattern. So you want a wider opportunity set, and rectangle provides that. So I came to realize that more and more rectangles are appearing on charts, and they end up being reliable. Just to give you some statistics over 7 years of chart pattern signals, I have 1,526 occurrences. Out of those, 654 were rectangles. So close to half of them were rectangles that formed on price charts. Now this could be a bias on my side, because the more I realize that rectangle is succeeding or they are reliable, the more my eyes are looking for that. But also rectangles are easier to recognize on the price charts because they are so clean, tight consolidations on the price chart. So out of these 654 over the past 7 years, 415 of them reached their price objective, giving a success rate of 63.5%. So the overall success rate for 8 chart patterns is at 59.5%. So clearly rectangle is above that average, giving you the upper hand that if you keep on focusing on rectangles, you will have a better edge in finding profitable setups. So, for example, people say, what is the requirement to find the rectangle? What's the what's the qualities that you're looking for in a rectangle? For me, rectangle needs to have minimum 2 touch points. So you have two highs to draw a line. But the third one, if it's a breakout, it's less reliable than the fourth one when it's a breakout. So I like several touch points to a boundary. My eye keeps on looking for these more frequent tests of a pattern boundary, and that I think that the more tests of a pattern boundary, the more valid that level is. So around that level, many transactions happen. So buying and selling happen. So it's an average, it's a cost area. The more developed it is, the stronger the breakout that follows it. So even with head and shoulder continuation or ascending triangle, the same thing applies. When you have that horizontal boundary, I like to see several tests of it. If possible, 3, 4 tests, and then the fifth one is a breakout, or the fourth one is a breakout, rather than the third one is a breakout. So with that, I have more conviction to go ahead with that breakout signal.
Okay, let's say now we have maybe 3 tests and now the price is about to test it for a fourth time, right? So what is the specific pattern, trigger, whatever that you want to call it, that will tell you, okay, now it's the time to buy? What's the thing that you look for?
So ideally, the stock needs to break out strong. Now, there are different methods to confirm a breakout, and this is one of the questions that I get a lot, and I feel like a lot of people are spending too much time on this, focusing on this, than actually focusing on what matters. So what they are focusing on is how to avoid the false breakout. And I always say that there is no way you can avoid a false breakout. False breakouts are going to take place. Okay? So this is a trade-off now. The breakout takes place with a long white candle. That's a breakout confirmation. But then we're late. For example, gold on a monthly scale, huge monthly candle, it's a breakout, but we're late. Well, if you're looking at a monthly scale price chart, that first month of breakout from a 5-year low consolidation is not gonna be over in 2 months. So you have talking about a multi-month long uptrend that's starting. So it's okay to give away the first 5% or 6% of that move on a larger scale. So ideal condition is to look and wait for that long white candle to take place. Okay. What about the daily charts? If we wait for 6% move, the move is, let's say, 15%, half of it is gone. Yes, I agree with that. Then you need something else. Something else needs to be placed in the strategy. So one method is looking for an ATR based entries. So you define the upper boundary, okay, and ATR is the average true range. It is the volatility of the stock. So you can set, let's say, 10 period of ATR. You can take 10 period of ATR and add certain percent of that ATR above the boundary. And to be early, you basically act with a stop limit order. What's the trade-off? The trade-off is that at the end of the day, you might find the stock not breaking out, actually. So your protective stop is below the pattern boundary, and you're in a stock that didn't break out strong. But that is the trade-off. We have to face that trade-off. Now, that's going to reduce your win rate, but your reward, when it actually breaks out, is going to be much bigger than your reward when you wait for a confirmation by the end of the day, which will compensate. So your reward to risk is going to increase from, let's say, 1 to 2 to 1 to 4 with that type of a early entry, but your win rate is going to drop from 60% to 40%, but your risk reward is going to improve. So a lot of people don't want to be wrong, and they want to avoid. So it's like a trade-off. So a lot of people are going in between this. Wait for confirmation, but we're late. Don't wait for confirmation. Act early, but we get false breakouts. So the way to compensate is to accept that when it actually works with a 40% win rate, your reward is going to be 1 to 4 or 1 to 5, which will compensate for the loss of win percent. So these are the two things that people have to make peace with it. You either accept 60% win rate, waiting for a breakout confirmation, and accept 1 to 2 or 1 to 2.5 or 1 to 1.5, or a little bit less win rate, but a higher reward.
Okay. And what about then stops? Earlier you mentioned that your stops are usually below the pattern boundary. Am I right to say that it's at the low of the breakout candle bar?
That also can be managed with an ATR. So you can easily set up a percent of ATR below the pattern boundary, and then your stop limit entry, and the risk is predefined. So you know that ahead of time before you even enter the trade.
Okay, just to clarify, when you talk about the pattern boundary, so let's say we talk about the rectangle, would the
Yeah.
pattern boundary be referring to the resistance, which is the breakout level point, or would it be the low of the rectangle, which is the near support?
No, pattern boundary would be the breakout level on the
Okay.
upper side.
Okay, makes
So
sense.
we're
All right.
talking about a long trade here. So you defined your pattern boundary at 60. So 60 is your pattern boundary, and then you calculate your ATR, and let's say 62 level is the ATR that you would act during the day, intraday. And so you act on 62, and then the same amount of ATR you remove from the pattern boundary, you have 58. So 62 minus 58 is your risk.
$4.
Yeah.
Okay, that makes sense. Then what about targets? Right? I think from what I see on your Twitter feeds, your targets is usually price projection. Let's say the rectangle is between the lows is $50, the highs is $60. Your target is usually $10, 60 minus 50. So is that usually how you go about setting your targets?
Yeah, that's basically the depth of the pattern. You take it. Most of the patterns is the same, but price targets are guidelines. So price can exceed pattern price objective. Now, what I have done is, obviously, the service that I have started with classical chart patterns and the pattern identification, one size doesn't fit all. So everybody has a different style. Some people don't use stop loss, some people use stop loss. Some people look at weekly scale charts, some on daily scale charts. I advise people not to look at intraday charts because it's too volatile and easily manipulated. So daily and weekly scale, I try to focus, even sometimes on monthly. So what I have done is I have categorized breakouts. I said there are 4 types of breakouts. One, type 1, stock breaks out and rallies to the price target without any pullback. There is type 2 breakout, stock breaks out, pulls back to the pattern boundary, and then rallies to the price target met. And there's the third type of breakout, breaks out, pulls back to the pattern boundary, and dips below it. Okay? So now you have this guy who uses a tight stop loss below the pattern boundary, tries to maximize the risk reward, Okay. This guy needs to focus on the universe of type 1 and type 2. So that's his playground. That's actually what the outcome he needs to expect from the breakouts. And when I look at that, the type 1 and type 2 over the 7-year period classical chart patterns that I have analyzed, success rate is at 47%. So you can see that the success rate from 59.5 dropped to 47%, but only for those who are applying a tight stop, this will generate the edge, because 47% with a 1 to 3 risk reward actually is a successful strategy. Now, type 3 breakouts, when you take the type 3 breakouts, which basically I'm assuming that if you have a tight stop loss below the pattern boundary and price dips, you're stopped out. Okay? Those are out of the 59.5% success rate, those are the 12.5% are those. 12.5%. Now, one thing I've realized is this. Between type 1 and type 2, type 1 is 27% of the breakouts. Type 2 is 20% of the breakouts. What does that mean? That means if you are waiting for a pullback to enter, 27% of those breakouts you're missing out. So conclusion is this: breakouts should be acted at the time of the breakout to be able to capture the most rewarding ones. Because what I've realized is type 1 breakouts, which break out without any pullback and rally to the price target, are the ones that exceed the price objective. What does that bring us to? So if you calculate your risk reward initially as 1 to 3, with the price target in focus, and you realize that it's a type 1 breakout. How do you realize that it's a type 1 breakout? The stock broke out, rallied to the price objective without touching the price objective. We're very close, like 2% away from the price objective. At that point, you realize that you're riding a type 1 breakout. Okay? So you've already calculated 1 to 3. Why not wait for 1 to 4 and 1 to 5? There you basically capture the most out of a trend. So when you realize that you're riding a type 1 breakout, my suggestion to all my members and followers is that wait. Trail it with a trailing stop, because this is the winner. This is going to generate more in this uptrend, which will basically help you to achieve better risk reward in the breakout signal. So type 1, type 2. So this is how I categorized the breakouts. And this probably is my addition to the literature, let's say, because when you read Schabacher's book, Schabacher is mentioning that the best breakouts take place at the time of the breakout, which tells us that don't wait for the retest. And I found that from the 7 year of statistics that when you wait for the retest, it's the 20%. When you don't wait for the retest, that's 27% of the breakouts. And then I realized that if you look at those type 1s, they always exceed the price objective. Because it's logical. The logic is that if a stock is rallying to the price target, it has momentum. It's going to go. It's going to easily go to, your initial calculation is 1 to 3 risk reward, let's say. It's going to go to 1 to 4 easily. And that 1 to 4, it really adds to the bottom line.
That was really informative, Axel. I appreciate it. And you mentioned, let's say, type 1 breakout, you would raise your target further since there's strong momentum. You go with a trailing stop loss. So how would you then, trail your stop loss? As there are, I think, many ways to do it. So I'd like to hear, your approach to it.
Yeah, the trailing stop is the chandelier exit. It's available online everywhere. So takes the what I'm looking at is the 10 period ATR, but this period can be changed, and the multiples can be changed. So you basically hang the chandelier exit, let's say the trailing stop, from the high of that move. So if a stock is making new highs, it will hang it from that high minus the multiple that you define times the ATR period. Let's say 10 period ATR you're taking. 10 period ATR means it has a look back of 10 periods of true ranges. It takes the average and gives you that day's ATR value. So you say, okay, I'm going to hang it 4 times the ATR, which will give you a wider stop. Or you can say, I'm going to hang it 3 ATR or 2 ATR. This, again, one size doesn't fit all. People need to sit down and work on it and see which they are comfortable with, how much of that open profit they are willing to give back, how their stock is performing relative to their ATR value, how much of spikes there is intraday or intra-week on that specific stock. If they are going to apply it, for example, in the crypto space, too volatile, they need probably 5 ATR not to get stopped out. If they are going with a quiet, low volatile stock, 2.5 ATRs can be applied. So that you can basically adjust according to, or you can say, irrespective, this is what I'm going to use, 3 ATR or 4 ATR, and I'm not going to optimize it as per stock or per instrument.
All right. And if I'm not wrong, you mentioned that breakouts, there are different types. Did you say there were 4 types of breakout, or was it 3?
Yes, 4 types of breakout. 4th is a failure.
Oh, 4th is a failure. So it's a false breakout. Okay.
Yeah, 4th breakout.
Okay.
So
and let's
that
say,
one,
yeah.
that one doesn't even recover like the type 3 after retesting, after dipping below the pattern boundary. So once it falls below the pattern boundary, it's a straightaway failure. It just goes down to the end of the range.
Okay. So if that's the case, right, your stop loss, do you wait for the price to kind of like close below your stop price level, or is it more of like a touch and then you're out of the trade?
Stop loss should be touch. You cannot wait for a close because there are all kinds of adverse movements in the market, and you cannot wait for a 20% down move at the end of the day to exit a position.
Okay.
So stops should always be at the market, in my opinion.
And let's say, assuming that you're just going to go with a normal breakout, you have your entry, your stops, and your target, right? Which is, you're predetermined ahead of time. And let's say the trade starts to move in your favor. Do you then kind of like, micromanage those trades, or it's either going to be hitting your stop loss or your target?
The statistics that I provide it's chart pattern price objectives, because like I said, if I apply 2 ATR, 3 ATR, which one is serving who, we don't know. So I basically give a set of occurrences, and that's how I divide it into type 1, type 2, type 3, so people can get a feel of those numbers. And so what I do is I define a chart pattern negation level, not a stop loss, but a chart pattern negation. For example, with head and shoulder bottom, it's the low of the right shoulder that negates the pattern. Okay, so let's say we have a head and shoulder top. The right shoulder of the head and shoulder top is the pattern negation level, which also is the level for a long signal for a head and shoulder failure. So it works perfect. So for ascending triangle, the low inside the pattern boundary, the minor low inside the pattern boundary, is the chart pattern negation level. For rectangle, it's a little bit more subjective because it's a flat area. So I try to find a level, a minor low inside the pattern that could act as chart pattern negation level. So the statistics that I have compiled are either stocks that are reaching to the chart pattern negation, or they go to the pattern price target.
That makes sense. Okay, makes sense. And I'm just thinking through, right? When you said that you're trading rectangles and then maybe it's a type 4 breakout where it's a failed breakout. I'm going to assume that that's a chart that you're probably not trade for a while, because right now your rectangle kind of like looks a bit weird with a spike up and spike down. Or would you kind of like redraw the triangle to take it into account that most recent high of the breakout, the false breakout?
No, I just moved to the next opportunity.
And
so
look for
I even when I was managing funds, you have a mandate, a benchmark. So the universe is limited. Okay, so if a stock is in the index and it had a failed breakout, you reduce exposure. But when it recompletes the pattern on the upside, you have to increase exposure, because you cannot stay naked on that position, right? So you have to, so that opportunity set was limiting. But for individual ideas that you have a blank sheet, you have a complete blank sheet to work on, you're not limited to that failed breakout, because once a faker, it will be again a faker in the future. So why not go with a more clean opportunity and start from scratch? So I started avoiding the type 3 breakouts, re-entry strategies. Though if you want to capture, I also have written about it and featured re-entry strategy as well, for those who are limited to a certain universe and they need to trade that stock. They need to get in. So a recompletion of the pattern would be your re-entry strategy. And these are the type 3 breakouts. That's 12.5% of the breakouts.
So what are some of your techniques that you use to re-enter such type 3 breakouts?
Type 3 breakouts are those that penetrate the pattern boundary and then recover above the pattern boundary. So if you have applied the ATR, let's say, trailing ATR stop to enter, it could be the same level. So the stock breaching that pattern boundary with the same percentage move or ATR move would be your re-entry level. Again, you will place the stop below the pattern boundary.
Got it. So from what I'm hearing, let's say, the price breaks out, it comes back down. Let's say the most recent high is at $60. So if the price exceeds $60 by a certain ATR margin, you can get long once again as a re-entry.
Exactly.
All right, makes sense. Got it. Awesome. So maybe now we can I think that segment was very tactical and I really appreciate it, Aksel. Even I myself, I learned a ton from that section. But now I kind of want to move on maybe to a more macro perspective, right, of trading. Yeah. So earlier you spoke about, entering end of week and end of day, right? So how do you decide, right, man, this chart pattern, I'll trade it end of day, or this one will be an end of week chart pattern? How do you kind of like decide on that?
It's the scale that you're looking at. So if you're looking at a daily scale chart, it's important to focus on the end of day price action. If you're looking at a weekly scale price chart, it's the end of week price action. Like for example, gold, two charts, I future weekly and monthly, and this is the month, and March was the first time that it's closed strongly above the pattern boundary. But the weekly signal came inside March. So the first week of March, if I'm not mistaken, was the weekly breakout signal. It was a strong weekly candle. So if you're looking and trading the weekly scale price action, you should have actually acted at the end of that week. But for a very long-term asset allocation perspective, you can easily wait for that monthly close and position yourself accordingly.
Okay, so in
one
other
of
words,
the things that I was doing was mostly focusing on the weekly scale charts when I was managing the funds. The reason for that is turnover. You cannot keep on acting on a daily, and then if it fails, exit and then enter again. So we were being punished by high turnover. Due diligences that were being done from investors were mainly asking about the turnover. So if you have high turnover, entry and exit, it is not considered to be good, at least for our mandate. It was not considered to be good. So I used to wait for a weekly signal, and weekly signal was my confirmation. And as I was waiting for the weekly signal, you cannot act on a Friday. In the UAE, it was Thursdays, end of week. You cannot act on a Friday because the size of the fund doesn't allow to enter with that size at the end of the week. So you have to basically scale in from Thursday or the day before. If it becomes clear that it is breakout, it's way above the boundary. So you spread your positioning into 2 days to 3 days, and even 2 days plus Monday. So I was looking at the weekly signals to have more conviction that this is a confirmed breakout. That also can fail. There's no guarantee, but at least you don't get whipsawed with daily scale charts, let alone intraday. So it's the scale, what you're looking at. Daily scale focuses on end of day. Weekly scale will be end of week closing.
You mentioned that you couldn't enter all on a Friday. Is it because the size of your fund is too big, and if you enter that one position on just one day, you will kind of like move the market? Is that why?
Yeah. I was the size was basically could lock the stock limit up in that day. One position size.
Oh, that's crazy. So yeah, so I know that you scan many markets, right, for opportunities from what I'm seeing right now. Crypto, forex, commodities, etc. How do you go about scanning so many markets for this type of different breakout opportunities?
I think, except given that we've discussed about the military service days, except the military service days, which was around 6 months, I don't think there has been a day that I haven't opened my Metastock charting platform. I don't think there was a day, even when I'm sick, it's like I feel blind if I'm not looking at charts. So, for example, on social media or on Bloomberg, or you see those charts, the news, oh, dollar is breaking out, and then I have to open that dollar chart. What is breaking out? And I realize that they're talking about an intraday price action. Nothing is happening actually. So every single day, I'm in front of my charting platform at least 2 hours, and probably I developed this capability because when you go through millions of charts over since 2000, let's say 24 years now, probably millions of charts have piled up in this. So when you go through those charts, you develop this pattern recognition capability. And I've seen it, interestingly enough, when I visit a city, I pass through a street, a coffee shop, and then I see that coffee shop or that street on a TV. And I said, we've been here, it was this. So that interesting pattern recognition development happened in my brain probably over time. And when I look at a chart, I immediately focus on the right side, and I know what I'm looking for. I know the qualities that I'm looking for. So that helps me to reduce the time that I scroll through a chart. Maybe 1 second to 2 seconds is my time that I spend on a price chart. I go through the list very quickly. So let's say 2 to 3 hours per day is my review process. Sometimes it exceeds, but I don't realize. So it's if you enjoy the process, even if it's 4 or 5 hours, it would probably feel like 2 hours. So
That's dedication, man. So, like, I mean, I'm just curious to hear, what is your watch list like? Do you like start with like all the stocks that start with capital A, then go down to B, C, D, E, F, G, all the way to Z? Is that how you go through the individual charts or stocks?
the platform that I'm using, MetaStock, has become more and more organized over the years. I love their platform. And so they have basically a drop-down menu for each market. So Nasdaq, 3,000 names. New York Stock Exchange, 4,000 names. They have Hang Seng Index, 40 names. CAC, 40 names. So I add them all into a list, and I divide them into geographies. So Asia, Europe, Americas, Middle East, and Africa. So that's my basically group of stocks. And right now, for my timing, it's 11:16. In 2 hours' time, Asia will close. Asia will include Japan, Hong Kong, Singapore, Australia, New Zealand stocks. Stocks that are above a market cap of $500 million. That's my filtering. So I'm going to sit down and spend a good 1.5 hours, 2 hours to go through those quickly. And with my timing around 7 o'clock, which is my after my dinner time, Europe closes. So I go through Europe and Middle East, Africa stocks. And then at the end of the day, around with my timing 11:15, 11 o'clock, US closes. US is a larger universe, and I don't want to stay too long. So what I do is I try to go half of the US list around 11, and then the next morning I continue when I wake up. Basically, from 6:30, 6 o'clock till 8 o'clock, I do my US studies as well. So that's how I manage the review process. These are daily. Every day I do this. And at the end of the week, weekends, I do the same for weekly scale charts. No end of month. I'm not doing that. But for weeklies, I'm doing the weeklies as well.
So easily, like each day is like thousands of charts each day. Each day you're just
Thousands
going
of
through.
charts. Yeah.
So if like you take 2 seconds for a chart, you go through 1,000 charts. It's like you can do the math, right? How much time you spend.
Yeah.
And it's not gonna be 2 seconds because you take time to go from one chart to maybe some delay from the platform and stuff like that. Wow. All I can say is wow. Okay, so my next question was actually about to ask, what's your take on trading pullback? But I think you talked about that earlier. If you wait for a pullback, right, you're gonna miss the move 27% of the time, especially it's a type 1 breakout. So I think I'll skip that question unless you have something to add about that. Do you have anything to add about trading
I
pullback?
think pullbacks, if it's part of your strategy, okay, you have to know that at least from my statistics, you're dealing with 20% of breakouts being a retest and rallying. So this is your universe. And if you're able to manage the risk reward, because it's going to give you a better entry, right, when you have a pullback, it's also difficult to time the place where the pullback is going to stop. Sometimes the pullback is short, sometimes it comes all the way to the pattern boundary. So that waiting or that not getting filled in that trade is full of regrets. I wish I put it here. I wish I put my entry here. So where do you exactly put that entry? So waiting for that pullback, I feel like it's a lot of regrets. And regrets are painful. You don't want to have regrets. You want to basically go with the flow and execute that strategy and accept the result.
And since you look at thousands of charts each day, and I'm pretty sure more than one trading opportunity might come up maybe they're both like, rectangle patterns, right? So how do you then decide which trade you want to take?
It's the rectangles mainly. And then there is obviously the list drops down because the opportunities drop down because it is important that you look at what news event is pending. I like to see breakouts that take place without any news effect. So let's say the stock has an earning announcement in the next 2-3 days, and the stock is breaking out. I would rather skip that because there's going to be a lot of volatility once the earnings news announcement hit the market. I like to go with those breakouts that have no event around them. So either corporate actions, news announcements. So the list actually drops down. So that's how I filter. And mainly focusing on the rectangles. For shorter term trading, the bests are from 2 months to 4 to 5 months consolidations. For longer term, I like to take the weekly signals on weekly charts, which are year long to 2 years long. That these are the longer term patterns that you can have wider stops and let it go. Give room to that idea to develop. But for shorter term, you also have this filtering that comes from 2 months to 4 to 5 months breakouts. The tighter the range, the better it is. The value of that range should be ideally 10 to 15% of the price. When those opportunities arise, those are the higher conviction setups.
So when you said the range should be 10 to 15% of the price, so let's
Yeah.
kind of like make things simple. Let's say the stock price is at $100, so the range should be anywhere between $85 to $100, that kind of
Exactly.
range, right? Because anything too
Exactly.
wide, then the range gets ridiculously large.
Yeah.
Okay,
Yeah.
makes sense. Okay, and what's your take on the concept of relative strength? Is this something that you pay attention to?
Relative strength, yes, I paid attention to, and with my work with some of the funds, which I do consultancy, I also help them with relative performance charts. Relative performance charts are valuable, and interestingly enough, chart patterns form on them as well. But obviously, you shouldn't exaggerate the variety of the charts. It's again rectangles and some short flag consolidations that you can act on, or else trying to find exotic chart patterns on relative performance is a little bit overstretched. So what I used to do is at the time of management of the funds, I had the denominator as the index, MSCI UAE index. So all stocks relative to the benchmark I had to go through to see which stocks are actually outperforming the benchmark, which stocks are underperforming. So you cannot go against the tide. It's the bigger picture. So let's say right now you look at Nasdaq versus Russell. Nasdaq is outperforming. So the tech stocks are where the action is happening. So it's maybe better to, if you're a top-down guy, you would be looking at the tech stocks versus the Russell names. So relative performance is important, and it can be utilized in different strategies as well. And I enjoy looking at them because they are pure price charts. It's like euro versus dollar, Microsoft versus Tesla. It's the same idea. The same patterns can form the way an FX chart is forming.
Would you then like use that and take that into consideration as part of your own trading? For example, you notice on a particular commodity A and B, right? They're both commodities. Maybe commodity A, the relative strength is stronger compared to commodity B. And maybe commodity B has a potential rectangle breakout happening as well. And maybe for commodity A, the breakout has already occurred. So would you consider buying the breakout on commodity B, knowing that in terms of relative strength, it's not as strong compared to commodity A? Does that make sense?
Yeah, if I was applying a different strategy, I would have. But at this point, it is too time consuming to incorporate different tools and inputs into my decision making, because I'm pure momentum based breakout strategy guy. So for me, in a group, let's say I'm looking at European banks lately. European banks had a nice move. So let's say I spot 10 different European banks. Okay. For me, the most important signal is the first signal. The one that breaks out first will be the strongest one. So I go with that. I don't wait just because HSBC has better fundamentals. I don't wait for HSBC to break out when ING is breaking out or Unicredit is breaking out. The breakout signal matters the most for me. And when I'm looking at those European banks, just doing relative performance between each one of them is super time consuming. But it can be done. I've done it in the past, and I'm still helping some funds with the consultancy to look at relative performance. And I can say that it's an important component that you can take into consideration to capture longer term or slightly longer term movements between stocks, which one to prefer.
All right. But for yourself, because to keep things simple, you just simply go long the first breakout and just keep things simple as it is.
Yeah.
So I think another thing that from what I've gathered is that you love trading rectangles, and also you look at the 200 period moving average to kind of like define the long-term trend, right? So price above the 200 MA, the trend is up, you buy the rectangle, that's good, right? So what about, so am I right then to say that the stock market usually it's more in a long-term uptrend, it's more bullish than bearish? So most of your trades, I guess, is more long than short.
Yeah. Long
Okay.
ideas are probably 80% of all the signals so far. We had two different years, 2018 and 2020 during COVID, when markets tanked. And when there is a V reversal, I fail badly. Okay, I am not able to capture V reversals because I'm not a bottom picker. I like to see stocks rebound, form some kind of a base, and then start a new trend. So at that part, I'm lost. What I do is I try to immediately look at other opportunities that can give me the upside when the markets are having a V reversal. So basically, the 200-day moving average is very helpful in identifying those. So in 2018 and 2020, the MSCI All Country World Index, which is the benchmark that I'm looking at to give me the overall perspective for global equities, because I'm also looking at emerging market stocks. Sometimes there are some frontier equities that I future. So the MSCI All Country World Index, with its 200-day moving average, when it falls below the 200-day average and the market crashes or collapses, you start seeing bearish chart patterns completing. And I was able to capture maybe 10 to 15% of the ideas as bearish setups. but mostly it's been bullish setups, and I can say 80% were long ideas from the classical chart patterns. But that doesn't mean that if stock markets enter into a bear market and stay in a bear market next 5 to 6 years, we're not going to see bearish chart patterns. On the contrary, there will be bearish chart patterns developing. You just need an established trend to see more and more, because chart patterns at the end of the day are not magic, are not voodoo, or they are consolidation periods. Okay, so when stocks consolidate, they form one of those patterns. It's either a rectangle or ascending triangle or head and shoulder continuation, and they all tell the same thing. After this consolidation, a trend might develop, and your job is to capture that trend. And to be able to capture that trend, you first need to identify the consolidation. If you don't know what the stage of the market is, you will not be able to define the trend period, the following trend period. So chart pattern is actually helping us to identify that consolidation period. And it's just giving it a name.
So when I'm going to backtrack a little bit here, right, and maybe talk about consolidation rectangles, right? So want to know, how do you draw these boundaries? Because not always, right, the price will just, at the exact sense, right, it rebounds. Sometimes it might exceed, sometimes it might not even touch that level. So how do you then connect the dots? How do you draw that horizontal line on your chart? What's your approach?
It's a little bit art than a science. I'm applying the best fit principle, and trying to touch as many points as possible on the price chart and get close as much as possible to that minor high or minor low. So that's how I'm basically drawing the boundaries.
And am I right to say that there will be times where if the boundary isn't as neat, right, the word neat as you like, you just ignore it and move on to the next chart?
Ignore, yes, ignore
Got
and
it.
move.
Okay.
So I'm not bound with that specific opportunity. That's the good part about having a wide universe and a blank sheet.
Yeah, that's
That's
the
the
beauty of
advantage.
looking at thousands of charts each day.
Yeah, you can look at another opportunity that has the perfect boundary and act on that.
Okay. And maybe to touch on risk management, how do you then manage your risk? I think earlier you talked about setting stops and targets, but maybe in terms of like percentage risk, or maybe like having a portfolio of 10, 20 stocks, is there like a limit, a cap to how many stocks or positions you'll be in at any one point in time?
Well, with my short-term strategy that I'm applying for my own, maximum of 5 to 6 position at a time, with 1% of AUM at risk. This doesn't mean 6 of them stays open. Some of them reach price targets, some of them get triggered, and you have to get out. But mostly not more than 6 open ideas at a time, which puts you around 4 to 5% value at risk at any point in time.
So if the worst thing happens, just boom, right? 5% max loss. That's it.
Sometimes not exactly, because some stocks open with a gap down, but also there is gap up openings as well. So law of large numbers takes care of it over the long term, that bad things can happen, but good things can happen as well on the upside, where you haven't measured, that is gifted to you, like the way a gap down happens. But it nets out with over hundreds of ideas.
Based on your maybe experience or data that you have, do you find that the stocks that you hold, the gap up occur more often than the gap down, since you're trading the direction of the trend?
I think experience over 4 or 5 years, I would say equal amount of times I've experienced. I've experienced some really nice surprises on the upside, and some nasty surprise on the downside as well.
And when the market is open, so I'm guessing your stops, you then would put the stops with your brokerage, or is it more of a mental stops once the target is
No,
reached?
it's always at the market. The stops has to be always on the market.
Okay, got it. And maybe just to move on and talk a little bit about crypto, right? Because you do share
Crypto,
quite a
yeah.
few crypto charts. What's your take on the crypto markets, maybe in general?
Crypto markets are interesting. So many tickers out there,
Yes.
and it's like stocks that go on IPO, and companies eventually, some of them go bankrupt, they get delisted. I have so many tickers that got delisted in the crypto space. So it's another instrument of speculation. That's what I'm seeing. Some are going to survive and become a D-thing, which is going to be part of the next gen, probably currency or the financial medium that we get involved in. But most of them are going to be just a periphery speculation instrument. That's how I'm seeing it. But what crypto created is the easy access for the general crowd to, one, open an account. Opening an account is super easy, right? With the camera recognition, you're able to open an account and deposit money and trade cryptos. And the second is that it gave the crowd the opportunity to get involved in financial instruments and have the possibility of making money or losing money. Today, you cannot even open a bank account in that short period of time, which is much more established institution, or a brokerage account. You have to go through so many due diligences and checks and so on. So its easy access is helping it spread widely and fast as well. When I share a crypto chart, it gets 10 to 15 times more likes in social media than a stock chart. And a stock chart is not a simple stock chart. It's sometimes Tesla. But FET US dollar crypto chart is getting 300 likes versus a Tesla 100 likes. So the involvement in crypto is massive. That's what I'm seeing right now.
And because the crypto is quite a new market compared to established markets like the S&P, Nasdaq. So do you find that maybe breakouts on these markets tend to be more reliable in that sense? Yeah.
Yes, it's momentum driven, less fundamentals. It reminds me of my early days in the UAE, where companies were not publishing financial statements on a quarterly basis. You used to wait, there were delays and so on. So even the fundamental fund managers had to rely on technical signals to manage certain positions. So fundamental information was limited. So it was mostly momentum driven and psychology driven. In crypto market, I'm seeing it similar, except probably Bitcoin or ETH that has story
Which are more established.
Yeah. So mostly it's momentum driven, I'm seeing. And the percentage moves also shows that per day.
I was just thinking through, right? So earlier you talked about your short-term trading. At most, you hold, I think, 6 positions. But I forgot to ask, what about your long-term trading or investments? How do you then manage your risk in that aspect?
Long term, I like to go more illiquid assets. I'm diversifying my assets into gold, real estate, larger portfolio of passive income generating assets. So the trading side is basically not a huge part, but just enough to generate some return. And other parts are more tied to passive income generating assets. I have had some success over the past couple of years in real estate. And it's probably interesting that a stock trader or somebody who has managed funds that hasn't hold the assets physically is looking for more physical assets to balance his his portfolio. So I like the physical aspect of things, to see the real estate, to see its presence, basically.
Let's talk about real estate then, right? So is it like real estate? Where do you invest? Is it areas of your expertise or overseas, local, etc.?
Real estate is the places that I live, basically. I never look at real estate as an investment, but more like, would I want to live in this place? That's my initial motivation. And I've realized that over the past 6-7 years, the real estates that I got involved in Bulgaria, Eastern European market, some in Greece as well, which is a close market. Both have been in resorts, so very much tied to the economy, and the economy is booming. If you look at stocks of Airbnb, Booking.com, travel companies, leisure companies, their stocks are booming. So the economy is booming. There's inflation, and those assets have tripled in price over the past 4 to 5 years from the time that I got involved. Bear in mind, they're not big ticket purchases. So I realized that smaller units are more in demand because of today's family structures. People don't want to have 4 or 5 bedroom places, versus they're happy with the small family, 2 bedroom, 1 bedroom units, houses. So those assets have picked up more, I feel like, in price versus large properties. That's my experience in this region.
So from what I'm hearing is, you would want to buy real estate places that you want to live in, and ideally kind of like the smaller size units, right? Because of the family structure.
Yeah,
Is there?
I like to feel the market, because I don't want to go and invest in Hong Kong right now. Okay, real estate, which I have no idea, but what I'm seeing, I'm comfortable with. I want to breed that market's momentum. I want to see the infrastructure improvements, the developments that are taking place in that place. You go vacation, you go see the improvements, and you have a feeling of the place. So those are the places that I feel comfortable to in placing my investments.
Is it a similar philosophy as breakout trading? You want to see momentum going on around that place before you kind of
Looks
like
like, yeah,
buy that?
yeah, sort of.
Okay. So you're not so much
You
of the
want to
kind
see the confirmation. You want to see.
so you're not so much of a person of like, let's say, oh, there's a financial crisis, real estate prices is low, let's go in and buy some stuff. You're not the kind of value investing per se, but more of like, well, things are doing well, let's get in at this, price when things are looking good.
Yeah, sort of. But also, let's be fair, because I got lucky with some of my investments here in Bulgaria. I saw the opportunity, and this probably is because of the places that I've been to, that I lived in different places, and I've seen that there's an opportunity that people are not seeing it, and it ended up being the bottom. So that nobody wanted to touch right before COVID, and COVID even made things more exciting, because the place that I'm right now is away from cities, so people rushed out of cities to suburbs, and people started valuing more the life outside of cities, which gives them more freedom, and home office concept also helped to push the prices of suburban living.
So now that prices are like, higher compared to where you bought them, do you have plans to exit those long-term trades, or it's kind of like continue holding?
I think continue holding, because they are generating passive income, and it's always good to have passive income generating assets in your holdings. They pay the bills and keep you comfortable while you're trading. So that's basically it. Right now I don't have plans to sell. Prices were really low in Bulgaria, and especially in this part of the country. I don't know how things were in Singapore or in Asia, but for example, in Dubai, we're talking about prices of $2,500 to $3,000 per square meter. We were at €300 per square meter here. And now prices have picked up to €1,100 per square meter. And there is probably potential of it going to €1,500, €1,600 per square meter. It can easily go there, because people start valuing quality of life in a different way. As businesses, as the concept of businesses change, it's becoming more and more online. Education is becoming more and more online. People are not tied to cities anymore. So they want the fresh air, they want the recreational activities. So I feel like more and more outside of cities are going to benefit from this change of trends in AI and how we work and how we study.
A very similar phenomenon has happened in Singapore as well. I think COVID, right? We thought housing property prices will drop, but like you said, right, more people work from home, remote working, prices here actually soared, right, to pretty high now. So I think, I don't know, we talk about per square feet, private property is about $1,000 per square feet. I'm not sure what's the conversion to a square meter, but a typical property here, 1,000 square feet house, you can expect to pay from between $400,000 to $1 million, and that's public housing. It's not even private. Private, you're looking like seven figures and beyond over here. So it's pretty crazy over here.
Yeah, I mean, during an inflationary time, this is an asset that's holding its value and increasing in its value. So it's by default that, okay, there is inflation, the dollar is inner value of the paper currencies are going down, so the assets are holding its value.
So is that the same reason why you bought gold? You mentioned gold as well?
Yes, those are the same reasons that I wanted to go into hard assets, because of the losing value of the currencies,
Yeah, the declining purchasing power.
declining
Yeah.
purchasing power. Yeah,
Yeah, especially I saw the chart
what you
of
were buying, you're not able to fill your basket in a store with what you were paying 2 years ago. No way.
I think you posted the chart of a dollar against the Turkish lira a few times. It is crazy
That's,
chart.
yeah,
It's ridiculous.
unfortunate. Very
Yeah.
unfortunate.
What about Bitcoin? I'm curious. Since Bitcoin apparently is kind of like digital gold in that sense, is this something that you hold as well?
Cryptocurrencies are an interesting field. It has its regulations. So with the through regulated instruments, I like to get involved with which is being available now more and more. So as long as it is regulated, given the countries that we're living in, everywhere has its own regulations and limitations. Still, the institutional system is not super comfortable with the instrument itself. So they're going to become more comfortable, and obviously there will be more regulatory leeways and allowances in different countries, I guess.
I understand. Now, let's move on to the closing section, shall we? And I'd like to hear maybe more about Tech Charts, right, which is the educational company that you founded.
Yeah, so Tech Charts started in 2016 as an educational and research service. So what I have taught is, given that I have developed this ability to look at charts in a clean way, and I realized that so many people who are starting in technical analysis and charting have the possibility of losing a couple of years the way I did, moving from one concept to another, hopping on a different strategy, looking at things in a different way, and figuring out. So I said I can easily help people to shortcut at least 2 to 3 years of their journey and start with a clean perspective, with what is working more often than not. So that was my initial motivation, because I worked with so many fundamental guys, and I believe that over the years that I worked with them, I've changed their perspective towards classical charting and charting itself. So a fundamental colleague of mine would sit in front of a Bloomberg screen with all the codes, tickers, and then he would have a daily chart open on a portfolio that he is managing and rebalancing it on a quarterly basis. So I used to say, why are you looking at a daily chart? You should be looking at a weekly chart for this stock, what it is doing. And I explained to them the trend periods and the consolidations at the most basic sense. And I realized that there is a lot of awakening happening there. And I think with this service, I helped a lot of people to have that awakening and to move faster to the next stage of their journey, where they can start applying the risk management, and the psychology of things, and learn trading by applying it, by doing it. Because I have a belief that you cannot teach trading. You can educate a doctor, you can educate an engineer, but that person needs to go out and experience it themselves. And a super famous doctor and an ordinary doctor, the difference is that it's the same as a super trader and an ordinary trader. There will always be this difference. You cannot, even the turtle traders were given the rules and how to apply it, but every one of them ended up different. So so it's that second part of that journey that they can start focusing on by accelerating this trial and error in the charting part that I want to help. And I think it's been helpful for many people. Meanwhile, let's not forget, I'm cooking food, okay, and this food is too much for me to eat, and I'm serving it. So the ideas that I'm generating, there can be 20, 25 ideas, and I might utilize 5 of them, but 15 of them are going to go to the garbage or benefit some of the members. So I decided that I can put out those ideas that I have found out as part of the membership service. So there's the educational part and the application part, the signaling part of the service that has been helpful to many who doesn't have the time to go through those charts every day to put that 2 hours extra time or 3 hours extra time. So I think it's been a win-win. It keeps me more focused and disciplined. When I write things, when I compile things together, I stay more focused. It helps me to basically organize myself, and it helps the members also to get something in return where first they shorten their time of research, second they shorten their time of journey in reading charts, in becoming more capable of looking at things, and third by giving them this educational videos, educational aspect of things, of how things worked in the past and how things can basically move in the future. A lot of people think that with the development of the financial markets, classical charting stopped working. But when I put a chart from 1940s, Edwards and McGee, and put a chart from crypto market today, it's shocking to see that they actually follow the same pattern in totally different markets in almost after 60 years, 70 years, or even a century long chart having the same pattern as today. So that's like awakening for a lot of people, and it makes them more interested to research the field, which I think I've been able to achieve so far.
Would you say then, since breakouts tend to work better in lesser popular names, less liquid markets, so chart patterns or classical chart patterns in general, would you find better opportunities, right, in the more obscure markets, right, compared to those which are that a lot of people pay attention to? So I guess for a new trader who maybe want to find better chance of success, focus on these obscure markets rather than the very popular ones.
I wouldn't say that because, like I said, for example, on Microsoft, you might not find that perfect rectangle forming every other month or in a year 3 times or 4 times in a year. But once in a year, you might find it in a very crowded stock like that. But in less focused names, you might find that setup more frequently. That's what I can say, because I've seen very liquid names having perfect chart patterns. This doesn't mean they don't form at all, but they are less frequent to come across. They are probably more like the pattern boundaries could be more violated than a less crowded stock.
Okay, so maybe just to clarify, when you talk about frequency, maybe let's say a very popular stock, maybe over a 5-year period, that tradable pattern might happen one time, whereas a not so popular stock over a 5-year period, that tradable pattern might appear maybe 5 or 6 times. Is that what you mean by the
Exactly.
frequency? Okay,
Exactly. Yeah.
got it. Okay.
But then we can go and take that Microsoft and then take that Tesla, take that ExxonMobil, take the other name, and then increase the frequencies of those patterns forming. So you still have that option. That's why I always advise to widen your research universe. Don't look at just Facebook. Don't look at just Tesla name. Look at a wider universe. Go a little bit more outside of that usual names to be able to find more of these setups.
Okay, that makes sense. And also, I think on your website, I saw that there is this kind of like a tagline. It says that in association with factor trading, which is from Peter Brand. So what's kind of like the arrangement or the link down there?
So the link is that Peter has been a mentor. In 2011, I've read his Diary of a Professional Commodity Trader. And that basically in 2007, I started applying the classical charting principles to the UAE markets. And then I started seeing the success. And then 2011, I started reading Peter's book, who has been applying it to the commodity markets, and it all clicks. And we interacted. And then I joined his Traders Bootcamp in 2014. And we started thinking of doing this bigger library of classical chart patterns together. So all this data that goes in to this database that I'm creating about classical chart patterns will hopefully become part of a bigger thing in the future, and part of a go-to source in classical charting. So basically in 2016, when we launched this TechCharts membership service, motivation is to focus on equities and try to collect as many data points as possible that we can study in the future and even apply different risk management on it, and to see what can come out of it. So this is our association with him, working on this together, and making it a much larger classical chart pattern library, basically.
Okay, got it. And is there anything that you wish to add or talk about that we didn't cover in today's session?
About the chart patterns, I want to discuss, because we've touched on rectangles. Our brains have the capability of finding out limited patterns at one shot. If you force yourself on, let's say, one stock to find 8 or 10 different chart patterns, you will be mistaken, you will be misled, and actually find things that doesn't exist. So I want to close this podcast session by giving a quick tip on people who are starting their journey, is to limit the number of patterns that they're looking for and increase the number of instruments. So let's say they focus on 2 to 3 patterns. Let's say rectangle or cup with handle. The cup with handle is the most popular lately because of the volatility contraction pattern that has been discussed in different books. So let's say you look at rectangle and cup with handle, but look at 1,000 names. in that cup with handle, even limit the time period that you're looking for. Like, let's say 4 to 5 months of cup with handle. Yes, the opportunities will be limited, but you will find your eye will start looking for that pattern constantly, and you will be able to find the patterns that are actually valid on the price chart, rather than opening one chart and trying to focus and say, is there a symmetrical triangle? Is there a wedge here? Is there a trend line here? Is there a head and shoulder? And the list goes on, and it becomes really confusing. And the best, actually, what I found is to limit the patterns, because we cannot process that much information at one looking.
This kind of reminds me of I'm not sure what's the exact term, but it's something along the lines of the reticular activation system, where your brain, starts to get very familiar with the pattern that you are seeing, and then it kind of like trigger whenever such patterns appear. It's kind of like muscle. You have to keep training it to develop that system, which is what you've done over the years, right? Thousands of charts each day, and now whenever you see a pattern, oh, that's it, right? Or if not, you move on to something else.
I even suggest people to print out the patterns that they have traded successfully. That is a textbook rectangle, textbook head and shoulder, and print it and post it on their desktop, and keep an eye on that. Keep an eye on that to see what they're looking is actually resembling the same pattern, be it the time period, be it the depth. Soon, artificial intelligence softwares will be able to capture those. I'm 100% sure that we're going towards that direction. But until that happens, we're still alone in this process to find the patterns that we want to trade and act on them.
Awesome. And where can traders find you, right, if they want to connect with you?
I'm on Twitter, Tech Charts. Online, I'm on techcharts.net. And YouTube videos are also available with Tech Charts extension. So if they go to my Twitter profile or X profile, Tech Charts, they will be able to see the links for YouTube and for my website as well.
And I highly recommend, right, traders do so, because your Twitter feed has one of the cleanest, right, classical chart patterns feed that I've come across. So, traders should definitely check your Twitter feed or X feed out. Yes? So thank you so much for your time, Aksel. I appreciate it. It has been a fantastic session, right, speaking with you.
Thanks, Rayner. Same here. I appreciate having me on your show.